In this video, we're going to talk about owner's equity and why it's so important. So in last week's video, we talked a lot about the balance sheet. And so in this week's video, I wanted to focus exclusively on owner's equity. I feel when a lot of people talk about the balance sheet, they talk a lot about assets and liabilities. And those are important, but owner's equity is equally as important. So what is owner's equity? Owner's equity describes the ownership's claim to the assets of the business. So in a balance sheet, you're going to see the different creditors of the business listed out. You're going to see different liabilities. You're going to see you might owe money to suppliers. You might owe money to the bank. Well, so those are captured in liabilities. Owner's equity is going to be the remainder of the assets in the business that is attributed to the ownership. So to discuss on why this is so important to understand what's going on in owner's equity, I want to talk about two main concepts, and that is capital structure and liquidity. So let's start with capital structure. Capital structure describes how the assets of the business were funded through a combination of debt and equity. So the assets were brought into the business either by taking on liabilities or by contributions through owner's equity. Now, to illustrate this, I'm going to use a very simple example of a small business. So let's say an individual is setting up a small business and they use all of their own money. They're going to put so much money into a business, and that's going to be their total assets. They're going to have zero liabilities, and they're going to have 100% owner's equity. Now, you can describe a capital structure in a business through a ratio, and that's called your debt to equity ratio. So in this example, we can use debt to equity to describe liabilities versus owner's equity. You have zero liabilities and 100 owner's equity in this example. So that's your debt to equity ratio. Now, what we'll see over time is that this debt to equity, this capital structure, might shift. And this business owner, for instance, might take on more debt. They might start to owe some bills. They might take on a small business loan. And so if we look at the balance sheet shift over time, we might see that in this example, liabilities go to 50 and owner's equity goes to 50. So they've taken on more liabilities, and your debt to equity ratio has actually gone 1 to 1. There's an equal amount of liabilities to owner's equity. And this is important to understand because the ownership has less claim to the assets of the business because some of these assets are owed to other creditors. So it's important to understand where the ownership stake in the company is. Now, this is a very simplistic example, but you can extend this to billion-dollar global corporations because it works the same way. They have a balance sheet, they're going to have a debt-to-equity ratio, and that says a lot about the capital structure of the business. Now, if you're looking at a business to purchase stock, I want you to not misunderstand me here because there's a lot that goes into a stock purchase more than just owner's equity on the balance sheet. The valuation of a stock is primarily driven by the expectation of future dividend payments. And the balance sheet actually says very little about that. But it is still important to understand what owner's equity is telling you about your stake to the company assets compared to other creditors. And let me tell you this, when a bank is considering giving a loan to a company, they look very closely at owner's equity on the balance sheet. They look very closely on where they're going to stack up against other creditors in the business. And so your capital structure and your owner's equity is very important to understand. Now, there's one other thing I wanted to emphasize here, and that is that there is not one ultimate capital structure. There's not one ultimate debt to equity ratio that you're targeting and trying to hit? It depends on your situation, it depends on the business and the industry. So in some cases it might be beneficial to have a higher percentage of owner's equity. In some cases it might be beneficial to have a higher percentage of debt. And in all cases, having a lot of debt's not necessarily a bad thing. Debt has certain tax advantages. It might be leading to more profits for the owners. So there's a lot that goes into determining what is a good capital structure. But the point I want to make here is that regardless of what the capital structure is, it's important to understand what's going on there and what it means for you as a stakeholder in the company. So that is capital structure. Now let's move to liquidity. So what is liquidity? Liquidity is basically describing how you're going to use the company's assets to cover company liabilities. And so if you're basically going to liquidate the company, it's talking about your ability to sell off your assets, take that dollar amount, and pay off your company debts. And then how much money are you going to have left over? That's liquidity. So this is usually described through a ratio called the quick ratio or the acid test ratio. And so what this ratio does is it looks at all your current assets, excluding inventory, and it compares that against your current liabilities. So the reason you take out inventory is because sometimes you can't sell off inventory very quickly. So you want to look at what you can convert quickly into cash. So that's your current assets. That's going to be things like cash, investments, and accounts receivable, and compare that against your current liabilities. What are the debts that are coming up that have to be paid? And so you're trying to understand here, do you have the assets to cover your debts? And how much money are you going to have left over? Now you might be asking at this point, what does this have to do with owner's equity? Owner's equity is not even in this ratio calculation. So this is a very important concept to understand. So owner's equity is very important in the liquidity calculation. Because let's think about what we're actually calculating here. You're using your assets and you're using your liabilities, but what you really want to understand is that dollar amount that's left over. What is that dollar amount? That dollar amount is the amount of money you have free to operate your business. And that dollar amount is really the current portion of your owner's equity. Now this dollar amount's not going to appear on your balance sheet. It's not going to be there. It's just a portion of, it's built into your overall owner's equity dollar amount. But you can calculate it using your ratios, using your quick ratio. So if you look at your current assets, excluding your inventory, subtract out your current liabilities, using the balance sheet equation, assets equals liabilities plus owner's equity, you can calculate out this current portion of owner's equity. That's what you really want to understand when you're calculating out liquidity. So the reason why you need to know what this number is because I'm helping you avoid a trap. And the trap is this. If someone comes to you and asks you the question, how much free cash do you have to operate your business? You don't want to go look in your cash account. That's not the answer to the question. Because if you look at the dollar amount of cash on the cash line of your balance sheet, the problem with that dollar amount is that there's probably a lot of claims to that cash from your current liabilities. So what this person's really asking is, what is your current assets minus your current liabilities? What is the dollar amount that's left over? Well, that dollar amount is the current portion of your owner's equity. So it's not your cash account, it is your current portion of owner's equity. Now, this is just a really important thing to know in the day-to-day operations of your business. How much money can I go out there and spend? So, to recap, we talked about some of the reasons why it's important to understand what's going on in owner's equity. And we talked about two concepts. We talked about capital structure and we talked about liquidity. So I hope you liked this video. If I talked about some new insights for you or some new ways of looking at the balance sheet, write a comment down below. Let me know what you think. And if you like this video, please subscribe to the channel by clicking on the button below. I release a new video every week giving you my tips and tricks on accounting and corporate finance, so please come back and check out next week's video.